Shocking evidence on why inflation will kill our purchasing power even more. Billionaire investor Charlie Munger, Warren Buffett's partner at the Berkshire Hathaway BRKB, recently stated at the Daily Journal's annual meeting earlier this year that serious turmoil was on the road for markets. Be sure to keep watching until the end to know why inflation will kill our purchasing power even more. Welcome back to Proactive Investing. Hit the like and subscribe buttons, and don't forget to share these videos to your proactive friends. Turn on the bell icon to receive notifications about our upcoming videos. Billionaire investor Charlie Munger recently stated at Daily Journal's annual meeting earlier this year that considerable trouble was on the way for markets, saying, quote, "What we're getting is wretched excess and danger for the country. Everybody loves it because it's like a bunch of people getting drunk at a party. They're having so much fun getting drunk that they don't think about the consequences. Eventually, there will be considerable trouble because of the wretched excess. That's the way it usually worked in the past." End quote. He went on to explain what he meant by wretched excess, saying, quote, "Certainly the great short squeeze in GameStop, GME, was wretched excess. Certainly the Bitcoin BTC USD thing is wretched excess. I would argue venture capital is throwing way too much money too fast, and there's a considerable wretched excess in venture capital and other forms of private equity. There's never been anything quite like what we're doing now. We do know from what's happened in other nations that if you try and print too much money, it eventually causes terrible trouble. We're closer to terrible trouble than we've ever been in the past, but it's still a long way off." While the SPDR P500 Trust ETF has returned minus 8.5% since that meeting, it has not yet encountered the serious problem that Munger mentioned. The effects are as follows. 1. Forward returns are likely to be disappointing. Given present macroeconomic and market conditions, the most important conclusion from Mr. Munger's words is that projected returns for the SPY are likely to be disappointing. The reasons behind these are rather obvious. For the foreseeable future, the economic growth prognosis is bleak, if not harmful. Earnings growth is going to be poor in the absence of substantial economic growth, and valuation multiples are higher than historical norms. According to data compiled by Current Market Valuation, the market is currently near the upper end of the reasonably valued range based on the equally weighted average of the yield curve, Buffett indicator, P to E ratio, interest rate, margin debt, and S&P 500 mean reversion models based on historical data. This suggests that it's overpriced, signaling that the market will produce subpar, if not poor, returns shortly. If you're enjoying the video so far, please subscribe to the channel and press the bell icon for more investment-related content, and we'll get back onto the video. Number 2. Volatility will most likely remain elevated shortly. However, interest rates remain historically low, and there is still a lot of excess capital circulating in global markets. As a result, there will almost certainly be plenty of dip buying, especially if there are any signs of inflation slowing, the economy faring better than projected, and the Federal Reserve beginning to shift its hawkish posture. Volatility will likely stay elevated as bulls and bears continue to slug it out fiercely, with bulls aggressively buying dips and bears selling dips on renewed fears of recession and further interest rate hikes. Thirdly, a market crash is very likely. A market crash is also highly likely right now, and the reasons for it are straightforward. As previously said, valuations are already inflated. Thus, a collision would not necessitate a significant deviation from historical valuation levels. In reality, a collision may be required to entirely correct financial markets following the decade of artificial stimuli provided by central bankers. Numerous catalysts could cause a market crash, and they appear more likely now than at any time in recent memory. A Chinese invasion of Taiwan, a nuclear war in Europe, a significant energy crisis if a war between Iran and Saudi Arabia begins, a massive cyber attack that significantly disrupts the global economy, or even the emergence of a significant new pandemic or variant of COVID-19. Charlie Munger said, quote, "When I was at Harvard Law School, we seldom traded 1 million shares in a day. Now we trade billions. We don't need a stock market that is liquid. What we're getting is wretched excess and danger for the country, and everybody loves it because it's like a bunch of people getting drunk at a party. They're having so much fun getting drunk that they don't think about the consequences. We don't need this wretched excess. it has bad consequences, and you can argue that wretched excesses of the 20s gave us the Great Depression and the Great Depression gave us Hitler. This is serious stuff, but it's awfully hard. A lot of people like a drunken brawl, and so far those are the people that are winning, and a lot of people are making money out of our brawl." End quote. He believes the stock market has devolved into a speculative gaming casino, discounted from fundamental stock values in many situations. This is what causes bubbles to form and then burst. He also added, quote, "When you throw away money, when you print money on the scale that modern nations are printing it, Japan, the United States, Europe, etc., we're getting into new territory in terms of size, and despite all of this very extreme government money printing that they've done, they haven't had terrible consequences. Now, Japan has 25 years of stasis with living standards not improving very much. I don't think that came from their macroeconomic policies. I think that came from the rise of tough competition for their export powerhouse from China and Korea." End quote. He continues on to say, quote, "But at any rate, it's weird what's happening and nobody knows for sure how it's going to work out. I think it's encouraging that Japan could print as much money as it has and remain as civilized and calm and admirable as it has. And so I hope to God the United States has a similar happy outcome. But I think the Japanese are better adapted for stasis than we are. There's never been anything quite like what we're doing now, and we do know from what's happened in other nations that if you try and print too much money, it eventually causes terrible trouble. And we're closer to terrible trouble than we've ever been in the past, but it might still be a long way off. I certainly hope so." End quote. Based on history, unchecked money printing eventually leads to financial consequences. Munger believes that Japan's ability to avoid the effects of its money printing will be the exception rather than the rule in the future. Trouble is on the way. Munger adds that the current inflation is different from what Volcker faced, and politicians do not appear to have the same willingness to tolerate economic misery to combat inflation. Volcker was given carte blanche to do everything necessary to control inflation. Powell might be afforded a different latitude. Most of the time, the difficulty of inflation leads to the rise of leaders who pledge to save the public and restore prosperity. This is frequently the entry point for dictators. Government expenditure benefits from the easy monetary policy since it leads to manageable debt without significantly increased taxation. Munger argues that this is the fundamental problem with easy monetary policy. The government loses fiscal constraint. There are no consequences for government spending and debt, so more of the same is done for political advantage. The United States is not Japan, and the upshot of our never-ending national debt and currency printing should be substantially different. The United States has been the world's economic development engine in the previous century, and the implications could be global. When a government destroys currency purchasing power, earning power, and savings values, huge political risks arise. A Western country is vulnerable to a muscular guy raising to dominance who claims to solve all of the country's economic issues and is rewarded with fealty when attempting to do so. His forecasts go beyond a stock market crash to explain the dangers of an economic impact and the risk of political instability. Munger believes that the US dollar will likely devalue during the next century. This isn't as insane as it sounds. Since the Federal Reserve was established, the US dollar has lost more than 96% of its value. The US dollar had similarly lost 86% of its value since 1971, when the US abandoned the gold standard. His prognosis is almost inevitable based on the purchasing power erosion trends. This should serve as a wake-up call about the long-term risk of inflation to savings accounts not invested in assets. That concludes today's video. Comment your thoughts down below, and as always, subscribe, hit the bell button, and thank you for watching Proactive Investing. We'll see you in the next video.